Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. We've got a fantastic deep dive today focusing on three massive structural shifts currently underway that are really reshaping the U.S. investment landscape. If you're looking for a quick, informed perspective on what's defining the market right now, well, you've come to the right place.
That's right. Today, we're drilling down into the data to understand not just what's moving, but the profound why behind those movements. We're talking everything from the silent revolution happening in your core investment accounts to the high-stakes, AI-fueled world of semiconductors and even, a rare critical look at an American investing institution.
Our mission is to unpack the hard data regarding what some analysts are calling the ETF market's triple crown, the undeniable presence of the DRAM supercycle, and also the structural risks that prompted a very rare sell report on Berkshire Hathaway. Let's jump right in with the phenomenon that's redefining how we all invest, the ETF market.
Okay, so when we look at recent analysis, we see this investment vehicle, the exchange-traded fund, the ETF, that has, effectively secured a triple crown for the year. This isn't just growth, it's dominance.
And the numbers defining the Triple Crown are huge, right? We're talking $1.3 trillion in asset flows,
Massive flows.
$0.53 trillion in trading volume, and over 1,000 new ETF launches hitting the market. It really shows complete mainstream acceptance.
Yeah, and what's fascinating here, or maybe a bit unusual, is the combination of that trading volume with a strong bull market. Usually you see volume spike during crashes or, high volatility when people are panicking.
Right, selling off.
Exactly. But here, high volume in a strong market.
Okay, so what does the data suggest is driving that? Is it just like retail excitement?
Well, not entirely. The analysis suggests that the high volume confirms that institutions, the big money managers, are increasingly using ETFs for active trading, not just passive holding anymore.
Interesting.
It also points to high levels of institutional rebalancing and, crucially, this massive appetite for those 1,000 new thematic and active ETFs that promise to chase specific trends, like AI or clean energy.
Okay, let's unpack this shift then, maybe by looking at the cost war. That seems like maybe the most ruthless part of this new landscape. We're specifically talking about the battle between the old king, SPY, and the newer challenger, VOO.
Oh, absolutely. This is a textbook example of how structural changes can just, kill incumbents. Vanguard's VO, the Vanguard S&P 500 ETF, just crossed a pretty stunning $1 trillion in assets under management.
$1 trillion, wow.
And it achieved that milestone in only about 15 years. It's been relentlessly chasing the original S&P 500 product, SPY.
And meanwhile, SPY, the original market leader, the SPDR S&P 500 ETF trust, has seen billions in net outflows recently. It's not like people suddenly hate the S&P 500 index itself.
No, not at all.
The analysis points directly to one factor.
Cost. Precisely. It's pure structural cost competition. Look at VOO and its close competitor, IVV from iShares. Both charge a microscopic 0.03% expense ratio.
0.03%, okay.
SPY, the incumbent, charges 0.20945%. That's nearly 3 times higher.
3 times. That 0.06% difference.
Oh.
It sounds tiny on paper, maybe.
Yeah.
But it acts like a structural weapon against SPY, especially for long-term investors, doesn't it?
Exactly. Think of it like this. Imagine SPY is like an older toll road. Reliable, been around forever, but it has this built-in toll, maybe 9 cents you can't avoid.
Okay.
VOO and IVV are like the brand new, super efficient express lanes built right next to it, and they only charge 3 cents.
Right.
If you're driving that road every day for 20 or 30 years, which is like investing your core retirement savings, paying that extra 6 cents every single time, compounds massively against you.
Yeah, thousands over the long run.
So cost-sensitive investors, the long-haul folks, they're rationally just switching to the cheaper, more optimized lane. It makes perfect sense.
It really hammers home how ruthless passive investing has become. It's just a race to the bottom on fees, and even the pioneers like SPY are starting to bleed assets.
And that leads directly to the core portfolio strategy supported by this data. The ETF is now, it's the undisputed standard tool for building a portfolio. Low cost, high transparency. So for your core foundation, the part you plan to hold forever, your S&P 500 exposure, the analysis says you must focus on the absolute lowest cost option available, like VOO or IVV.
But then you have those 1,000 new ETFs, the satellite holdings, as you mentioned.
Right.
So the idea is you use the cheapest options for your foundation, your core, but maybe use the specialized, often higher cost, active or thematic ETFs for specific goals or, chasing trends like smaller bets.
That's exactly what the data suggests investors are doing. It's a two-pronged strategy. Core for low-cost stability, and satellites for maybe trying to capture some specific growth or theme, offense and defense, sort of.
Okay, so we've established cost is killing the old giants in the passive investing world. Now let's talk about the engine that's creating the new giants and setting new price standards, the semiconductor cycle. Specifically, DRAM memory chips. The forecast of a massive price hike isn't just a forecast anymore, is it? It seems like we are definitively in a confirmed DRAM supercycle.
Oh, the market confirmation is stunning. Recent analysis confirms that giants like Samsung and SK Hynix, they secured 18% to 23% average price increases for their Q4 contracts.
18 to 23% in one quarter.
Average increases, and that's mainly with the massive cloud providers, the biggest clients. We saw some high-performance server DRAM jump by over 25%.
That's incredible. So the data validates reports suggesting this is maybe the largest quarterly surge the memory chip market has seen since the high-flying 1990s?
That's what it looks like, yeah.
But hang on, isn't calling this a supercycle just market hype? We've seen memory cycles boom and bust before. Why should investors believe the structural demand is that different this time?
That's the million-dollar question, right? And it's an essential challenge. The difference fundamentally lies in the nature of the demand engine. AI, previous cycles relied on, say, PC upgrade cycles or smartphone launches. Those were cyclical, often short-lived. This cycle, it's fueled by AI server acceleration, and that looks relentless.
Okay.
We're talking continuous, multi-year investments. Think projects like OpenAI's Stargate, or the massive CapEx plans announced by every major cloud company, stretching out through 2025 at least.
And that AI explosion requires massive amounts of high-performance memory, particularly this high bandwidth memory, or HBM.
Absolutely. HBM is the specific high-margin product that's really fueling this price surge. But the broadening base is what makes the cycle feel more structural this time. It's on-device AI.
On-device AI, meaning AI on our phones and computers.
Exactly. New AI-capable PCs and smartphones are shifting general consumer DRAM demand from just like a weak recovery to outright sustained growth. Ah, okay. So the analogy holds. The giant warehouses, the data centers, still need tons of memory. But now, every specialized delivery truck, your new AI laptop or smartphone, needs sophisticated capacity too.
Right.
That makes the demand base much wider, much more solid.
Precisely. Now, flip to the supply side, and the constraint becomes really clear. Why can't manufacturers just crank out more memory?
Yeah, why not?
Well, first, they are actively converting existing DRAM production lines over to making the higher margin HBM.
Ah, okay.
Which inherently limits the growth of standard DRAM supply. You can't really max out both at the same time with the same equipment.
And the second factor driving this?
Caution, plain and simple. Having suffered massive losses in the last down cycle just a couple years ago, the top three memory makers, Samsung, SK Hynix, Micron, they're being extremely cautious with new capital expenditure.
Meaning they aren't rushing to build tons of new factories.
Exactly. They're not flooding the market with new capacity this time. It's a controlled supply strategy. It helps maximize their profits and, frankly, prolongs the price strength of this cycle.
Right. So the key message from the analysis is this. Given the structural AI demand, both data center and on-device, and this limited cautious supply, it's probably too early to be debating the cycle's peak. The supercycle really could be longer and stronger than previous ones.
Okay, so if Samsung, for example, is prioritizing converting lines to HBM, does that mean regular consumers should expect higher prices even for standard laptops or PCs next year? Is that the ripple effect?
That is precisely the ripple effect. When the highest-end components like HBM command massive premiums and suck up production capacity, it inevitably creates scarcity and elevates prices for the more standard, generalized market as well.
So for investors, the insight here is clear. You need to differentiate and maybe look at the whole ecosystem.
Definitely. Focus on the leaders in the HBM market itself, like Samsung and SK Hynix, because they're capturing the highest growth and margins.
Okay.
But crucially, also look for the warming effect on suppliers. As these chip makers gain revenue and need to scale up HBM production, there's enormous benefit for what the Koreans call sobujang.
Sobujang. Remind me, that's the materials, components, and equipment sector, right? The suppliers to the chip makers.
Exactly. They provide the essential infrastructure, the guts, that benefit from HBM production scaling up. Especially companies focused on advanced packaging that tech needed to stack those HBM chips efficiently, they ride the supercycle wave without actually being memory producers themselves.
This transition actually leads us perfectly to our third major structural shift, where we see this new market reality really challenging old wisdom. We are turning to the investment giant Berkshire Hathaway BRK. An investment bank, KBW, issued a highly unusual underperform, which is basically a sell rating on BRK. That's the first major downgrade in something like 15 years, right?
Yeah, it's a monumental event in the financial world, frankly, and the stock has been under pressure. It's notably been lagging the S&P 500 even during recent tech-led rallies. It's just kind of sitting there.
And this isn't just about short-term performance wobbles, is it? The analysis suggests it's about structural issues in the core company philosophy.
That's the argument. Historically, a negative report on BRK was often seen as a buying opportunity. People believed in the Buffett premium, the leadership, but the analysis suggests this time might be different because the lag feels structural.
Okay, so what are the concerns?
Well, the KBW report focuses on three critical pillars of concern. The first one is probably the most sensitive: post-Buffett uncertainty, succession risk.
Right. With the formal CEO transition from Warren Buffett to Greg Abel nearing completion, there are just natural questions about his capital allocation strategy. It's not really fully market tested yet, is it?
Exactly. And that lack of testing creates concern. Maybe the lack of transparency that was kind of forgiven under Buffett's personal leadership becomes more of a liability under Abel. The market's asking, can the next generation generate the same returns without the legendary aura of the founder?
Makes sense. What's the second pillar?
The second is core business headwinds, just challenges hitting the company's massive subsidiaries. Well, Geico, the insurance giant, is fighting high accident rates and soaring repair cost inflation. That's hitting insurance profits hard.
Okay.
And BNSF Railway is seeing volumes slowing down due to the overall economic environment and, frankly, tough competition from trucking. Plus, their huge energy division, BHE, is facing absolutely massive capital expenditure requirements just to modernize the grid and transition towards clean energy.
So they're spending billions just to kind of stay relevant and meet regulations.
Pretty much, spending huge sums just to maintain their market position in a shifting landscape.
All right, and the third pillar. This feels like the big one.
It is. It's the most consequential and structural. The AI revolution gap. Buffett's core philosophy, which has served him incredibly well for decades, is investing only in businesses he completely understands.
Right, the circle of competence.
Exactly, but that philosophy now structurally excludes the cutting-edge AI and advanced technology that are driving so much of the current market growth.
Because he doesn't claim to fully understand them.
Right, so the Berkshire portfolio is heavily focused on traditional defensive value sectors: insurance, rail, energy, some consumer products. The analysis points out this structural choice means they are, structurally unable to participate in potentially the most significant, highest multiple growth cycle of this decade.
Wow. It's almost ironic, isn't it? Buffett made his legendary career largely by avoiding tech bubbles. But now avoiding tech, specifically AI, might be the single biggest liability for Berkshire's long-term valuation.
It could be the ultimate value trap, missing the biggest structural growth story in decades because of a long-held philosophical choice.
So what does this mean for investors looking at Berkshire?
Well, you have to reevaluate that Buffett premium. As Buffett steps away from the day-to-day, is that premium still justified if the company is structurally lagging due to its exclusion of AI?
It's a fair question.
Look, BRK remains a strong defensive play. It's stable, it holds value sectors, but investors have to consciously decide now. Do they prioritize that stability and traditional value, or do they want exposure to the market-leading future growth being generated by things like the DRAM Supercycle and other tech platforms that Berkshire just doesn't own?
That's the tension, isn't it?
Yeah.
You potentially sacrifice future growth for that current stability.
A tough choice. #tag outro.
Yeah, and if we connect these three areas, the ETF cost war driving efficiency, the DRAM supercycle fueled by AI, and the structural critique of Berkshire, we really see a market defined by brutal efficiency and incredibly rapid technological acceleration. You've got rapid cost optimization sweeping through passive investing, tech breakthroughs driving these huge cyclical swings in semis, and this generational shift challenging traditional investing models like Berkshire's. Okay, let's unpack this. What seems to link, say, VOO's success and Berkshire's challenges is the ruthless efficiency of the new market. It feels like if you aren't optimizing for the absolute lowest cost, like VOO, or optimizing for the highest technology growth, like the HBM makers, you risk being structurally left behind. Doesn't matter how great your history or reputation is.
That's a great way to put it. The biggest takeaway for you, listening is that in every area, whether it's your core ETF holdings or assessing a massive conglomerate like Berkshire, the priority really needs to be checking your assumptions against the new reality. And that reality is dominated by high-growth technology and relentless low-cost efficiency.
Which raises a really important question to maybe leave folks with. If AI continues to be the overwhelming structural driver of market returns for the foreseeable future, how long can even the best-run traditional businesses afford to structurally avoid that growth engine before their value proposition starts to, well, seriously deteriorate?
That's definitely something to mull over as you build your own portfolio.
Thank you for joining us for this deep dive.
It's always a pleasure.
Don't forget to subscribe and hit that like button.